A very good morning to you, team. It is Wednesday morning. We've just had the Nationwide HPI come out, and I can almost feel on the social sphere and on YouTube that the property bulls are going, "I told you so," and the property bears are scrabbling to find a narrative as to why this is a little blip, and actually it's going to carry on crashing pretty quickly. The joy of having a channel where we just look at objective data to make us make better decisions is we can just carry on with the narrative that we've been talking about for the last few months. So in today's live stream, I would like to cover or talk about what's just come out with the Nationwide House Price Index, but also relate it if we zoom out to what's going on in the wider market. So last week we saw Zoopla's last HPI come out. So we're going to look at Zoopla. We're going to look at the state of the housing market in terms of transactions. We're going to have the state of lending. We had some interesting lending figures come out in the last couple of days. So we're going to wrap all this up, see where we are in terms of a snapshot of the housing market before we go into the interest rate decision tomorrow. So firstly, a big welcome, a big good morning. If you can hear me and see me, because we are live, please give me a thumbs up. Please give me a comment in the box so I know that you can actually hear and see me. And if you're watching on the replay, please do play full on and put all your comments in. I'll always get back and answer them as well. And if you're new to the channel, welcome. I know we're getting lots more subscribers at the moment. These live streams are designed to cut through all the noise, all the headlines, look at the actual data and try and hypothesize what's going on now, but use it as a forward-looking indicator so we can chart what's going to be happening over the next 6, 12, 18, 24 months and beyond and make better and more informed decisions. So that's the aim for today. Let's have a look at what we're going to cover. So a few things said. We want to look at the Nationwide HPI. I want to look at Hoopla, that's a typo, Zoopla HPI, the RIC survey, money and credit, and then we're going to work out what's going on. So let's crack on straight away with the actual reply. Ian, thank you very much. It's all looking good. And by the way, I will get to questions at the end of going through all the slides and the content, so those watching on the replay don't have to hear me chatting and answering questions, but please do ask your questions or put your thoughts in as we go through. I'll be asking for engagement because we're on the live, and I'll come back and we'll have those discussions afterwards. So what's come out today? Look, we got here a monthly change, month-on-month change of plus 0.9%. I have to be honest, this actually has surprised me somewhat in terms of the monthly figures, which leads to us having an annual change going from minus 5.3%, we can see here, to minus 3.3%. So actually that annual change has gone up by 2% net on a year-on-year basis. Now, there's some reasons behind this. Number one, this time last year, we actually saw quite a big drop. This was when we started to see the big drops come in following Truss's mini budget, Truss and Kwarteng's mini budget. So we're kind of expecting to see that anyway, the year-on-year, not pop up, but be reducing less than it was last month. We talked about that when the last set of data came out. But it's this 0.9%. Now, this is a seasonally adjusted monthly change. That's something worth clarifying. So if you look at the actual figures, last month in September, we were 257,808. Now in October, we're 259,423. If you work it out on a purely nominal basis, that's actually about a 0.6% rise, not a 0.9% rise. There's some seasonality in there, but 0.9 is still pretty high. Now, I'm just going to flick over to trading economics here. This is what it looks like on the actual, if you actually plot the house prices for the Nationwide, this is what it looks like. You can see over here on the right-hand side, we have a little tick up. But I'm not so concerned about that graph. I want to look at the trading economics forecast, because what they do is there's a consensus of what's going to happen on the month, and they predict that, and then they have their own forecast. So if we look at October, for the month on month, so you can see previous September was 0.1%. The consensus for October was minus 0.4%, and the trading economic forecast was minus 0.1%. And as you can see, it's coming at 0.9% up. That's a fairly big difference, right? I would love to hear your thoughts on why you think we've seen that large spike up in terms of the month on month. Before I talk about it, I just want to talk about trend lines. Now, as you know, on this channel, I always say that we have to take month on month with a healthy dose of, not skepticism, that's the wrong thing, but we can't look at what's going on in the market as a whole on month movements. We have to look at the trend lines. Nothing goes up in a straight line, nothing comes down in a straight line. So if we look at the trend line here, And you can see on the right-hand side, we effectively hit that bottom after, sort of a big drop at the end of last year. We had our spring bounce, and then it started coming down again. You can see we're having another little bounce, right? But until this bounce goes, I would say, above the previous little high, we're still in a confirmed downtrend. So that's the first thing to say. So month on month, don't read too much into it. We need to see the trend line. Look, if it continues coming up for the next few months and goes above this, then we could say, look, the trend has reversed. But right now, we are still in a descending trend line. And also bear in mind, this is just the nationwide figures. The nationwide, in terms of a data set, just come off this for a little bit. In terms of a data set, the nationwide is probably the smallest set of figures. The Halifax has a larger market share than the nationwide. And so the Halifax often stays more true to the actual house prices, the actual UK ONS. So the nationwide is generally a little bit more bearish. But also, we've seen in the past that when the Halifax goes up, the nationwide goes down, and vice versa, which means to me there are fundamental differences in the model that they use to calculate. Now, this is not just taking the house prices or the mortgages that they are approving and taking an average, a mean, or a median. It's using a model called the hedonic regression model. And there are differences in the models that the different indices use. The main difference between nationwide and the Halifax is the same as the ONS, is that nationwide does not include buy-to-let mortgages, and of course neither of them include cash purchases, and I think that's making quite a big difference. So there we are. That's what Trading Economics says. So it thought it was going to go down 0.1% this month. It's gone up 0.9. Big difference. I think what's interesting is to look at the narrative, though, and the figures that come within the HPI. And actually, I was quite surprised reading the narrative this morning about how bearish it is considering we've just seen a 0.9% spike up. It means they're seeing other stuff in the data. So I don't think they're completely happy with this data set. I'm just gonna read this. The second paragraph says, nevertheless, the housing market activity has remained extremely weak, with just 43,300 mortgages approved for house purchases in September, around 30% below the monthly average prevailing in 2019. And this is a little bit too zoomed in. So, sorry, or zoomed out. So I'm going to zoom in to have a look at the graph of mortgage approvals. And this is going to be the crux of what we're going to be talking about today, is the fact that the property market is absolutely paralyzed right now. So the property market and the lending market, have just gone into basically a deep freeze. And if I zoom in here, right, and I should have the drawing on. This is mortgage approvals. Okay, so this is not home transactions. This is mortgage approvals. You can see here this dip down was after the mini budget, but of course we had a bounce. And by the way, nothing goes up and down in a straight line. So if we see something come down quickly, it's going to have a bounce at some point, right? And we had the bounce into the spring, but then we have now seen a confirmed downtrend effectively in terms of our mortgage approvals. So bounce, pent up demand, coming back down, and we are. If I zoom out again, right, and just take those green lines off, you can see that we're almost now down to the lowest level of mortgage approvals that we had at the end of that mini budget sort of drop, which is, I think, pretty interesting itself. And if we zoom out even more, we've got the lockdown low, which I think is fairly relevant. We've got our sort of 2014 to 2019 average of 66,000 a month. We're actually below the 2010 to 2012 average of 49,000 a month. And we hit a low of sort of 2008 of 26,000. So we're not a million miles away from that, okay? And it shows that we are in deep freeze. Now, let's try and understand this even more. So I want to go and have a look now at the Zoopla HPI. And the first, sorry, I should have had this set up. The first thing I want to look at is the demand and sales in the property market. So and by the way, I haven't looked at the Zoopla HPI for a while. I'm a massive fan of the model that they're using. I actually have a lot of respect for this HPI. I don't think we could really call it a house price index. We've got Rightmove, Nationwide, and Halifax as the main three. Zoopla calls itself a house price index, but really it's a model that's looking at all of the other data and gives us a forward projection of what's going to happen with house prices. We look at this every month. And I want to focus here on the buyer demand, where we're seeing a huge drop in buyer demand still. So the purple is versus last year, 2022, as an average, and the black is versus the 5-year average. So I think the 5-year average is the most relevant to look at. Buyer demand is minus 23% against the 5-year trailing average. Number of sales agreed is minus 14%. Okay, so not as low as buyer demand, but the buyer demand, of course, is going to be a more forward-looking indicator to the number of sales agreed. This is the big one for me, okay, is the flow of new supply. So right now, okay, we are seeing a negative trend in new properties coming on to the market. Yes, we could look at this stat here, the stock of homes for sale in isolation, and go, wait a minute, but we've got a load of new homes for sale. Is that not increasing supply? No. Okay. For me, that stock of homes for sale is going from a very historical low. And yes, we are seeing properties that have come on are not selling because we've got number of sales agreed dropping. So therefore, number of sales agreed dropping, we've got property on the market that's not selling. We're going to have an increase of stock. But the key metric here is the flow of new supply, because this is going to determine in the short term what happens to the property market. There's really two things that we can look at here in terms of flow. Well, what happens to the property market? If we have a massive spike of supply side, okay, with not a lot of buyer demand, this is the thing that's going to really drive property prices down. So when I talk about property prices, there's probably two main things that contribute to it right now. Well, probably three main things. One of them is interest rates. I would suggest another is unemployment, okay, but let's talk about unemployment in a bit. The third is the amount of supply side. And yes, we've got high interest rates, we've still got low unemployment, but what is completely obvious is that supply side has contracted so much. So there is just nothing going on. And if there's nothing going on in the market, we'll talk about why there's nothing going on in the market, and those transactions are low, then the data set that we're looking at is going to be completely skewed in my book. The smaller the data set, the more skew there's going to be in those monthly prices. Okay, imagine, let's take it to the extreme. If we take it to the extreme, and in September or October, sorry, there was, Nationwide did one mortgage approval, and it was at 300,000. Okay, so what's that? Sort of 40,000 above the last month's, right? It's going to show a huge spike up in average house prices. I know that's an extreme example, but I'm trying to make the point that when we have lower sample set, the skew is going to be higher. So just because there's a tiny little data set of mortgages approved from the Nationwide does not mean that all of the house prices in the UK are following that same trend. So that's why I think we need to take the HPIs, especially the smaller data set, with a pinch of salt. Super important. Okay, what else can we see from the Zoopla? In fact, before we go back to Zoopla, I just want to finish off what the Nationwide HPI is saying. It does say, okay, when we zoom in on it, it's not surprising that we're seeing basically a tightening or a lack of supply because the affordability still remains stretched. And the affordability is mainly driven by interest rates right now. So yes, we have seen mortgage interest rates relaxing over the last 2 or 3 months. And I think that's probably going to have had a little bit of an impact. And let me just zoom out on or get the right graph on the iPad. Okay, if we look at the mortgage rates, we had that big spike end of last year, post Kwarteng Trust mini budget, came down. Then we had another big spike when the swap rates went up when inflation was proving sticky. But over the last 2 or 3 months, we can see from this diagram here, those mortgage rates have been coming down. So it has given maybe just a little bit of breathing space from the people who need to move, or a little bit more confidence in the people who need to buy a house, that they can get a little bit more. If those mortgage rate, a mortgage rate at 5% is very different to 6.5% in what you can afford. There's going to be a little bit more affordability, but overall we're still high with average mortgages. Look at that 5-year fixed is still way above 5%, just below 6%, and 2 years, more than that. It's still going to be putting a huge amount of pressure onto these sale prices. Looking at the RICS survey, by the way, and again, I should have just stayed on the iPad there. If we look at the RICS survey, this was it's probably about 3 weeks out of date now, but this is their new buyer and new instructions. If it's below that black line, horizontal black line, it's basically negative. So we've seen a very small spike up in the last survey from the RICS surveys, but really we're still deeply in the negative in terms of both buyer inquiries and new instructions. And that goes to back up the narrative of how frozen the property market is right now. Okay, so that is probably the biggest takeaway we can take from where we are in the overall property market. Okay, so let's go back to Zoopla, because there's not really a lot else in the Nationwide other than that narrative that affordability remains tight and new sales, new instructions are in the negative, and sales are in the negative. So there's not a lot going on. If we look at other elements of the Zoopla HPI, it's now showing, so Zoopla has lagged behind in terms of the Halifax and the Nationwide in terms of yearly falls. We're now seeing this purple line effectively is showing prices falling. It could just be, even if it's 0.01% year on year, they've got 5 basically regions in the UK they track. So 4 out of the 5 housing markets, Zoopla are now saying we're negative on the year on year. So we've now got basically all 3 proper indices, our discount Rightmove, and we'll talk about Rightmove another time. Halifax, Nationwide, Zoopla, all saying pretty much year on year we're in falling. We haven't got this pink line. Pink line is more than 5% year on year. It's still resolutely flat in the Zoopla. And Zoopla is saying that they're not expecting year on year to be more than 5%, certainly in 2023, and potentially going into 2024, still saying the same. So when we look at house price correction or crash, you'll know there's, generally speaking, 3 scenarios we can see. One is house prices going up. Second is house prices coming down in a crash, which for me, a crash is probably more than 10% year on year. The other is a longer and slower correction, which is a shallower correction in terms of year on year, but goes on for a longer time period. And since I started this channel, I've been saying that has always been my highest probability. Out of all the possibilities, that is my highest probability. Looking at the macro factors, looking at the strong wage market, looking at the liquidity that's in the system post-COVID, we're likely to see a longer, more drawn-out correction. It doesn't mean peak to trough is going to be less. Peak to trough could well be more. It just might happen 3-4 years down the line. And I've also said that one of the major things we need to look at is the real house prices, because in a high inflationary environment, the nominal house prices are kind of irrelevant. It's kind of being skewed by inflation. Inflation is masking what's actually happening in the housing market. But let's just say Zoopla is mirroring the fact we are seeing year-on-year drops. Just to mirror again the sort of tightness in the housing market, estimating 1 million sale transactions 2023 with a 50-year average of 1.26. That's a significant amount down. And Zoopla are also estimating we're going to have the same into next year, into 2024, which is why they think we're probably going to see 2024 mirrored from what we see in 2023. So it's 5% in 23. It's a good chance we'll see another sort of 5% correction in 24. This is what Zoopla are saying. I'm not saying that is how it will pan out. What we are seeing is a lot more cash purchases in terms of percentages. Now, remember, when we look at these percentages, we're talking percentages of all the transactions, not against a trailing trailing data set. We've got the black is actually comparing the amount of cash purchases as a percentage of the trailing, but I'll be interested to see what those actual figures are. So we can see here on the right-hand side, we've got cash going from 20%, so 1 in 5 transactions, to 32%, 1 in 3 transactions. So 1 in 3 transactions right now are in cash. And when I say the actual amount, because there's so many lower transactions, that could well be a lot less cash purchases than we've seen in the last years, but it's just as a percentage of the data set, if that makes sense. So cash is still quite powerful, or cash is appearing more powerful, which makes sense with the narrative that interest rates are so high. Okay, let's take a break from that and let's see if we've got any questions. Richard, how are you doing, Richard? Said these figures are totally rotten. If demand is down to levels not seen since 2008, then do you really think prices are going up? No, I absolutely don't think prices are going up, Richard. And I am in agreement with you there. What I do think, as I said, is that there might have been some larger mortgages approved because, very slightly larger mortgages approved because of that slight drop in interest rates. People afford a little bit more. All right, so we've talked about HPI for both Zoopla and Nationwide. Something else I wanted to look at, because I think it makes up quite a big factor of what's going on a macro scale. And I want to start to sort of feather in talking about the economy as a whole and how that's going to be affecting the housing market over the next 6 months. Remember, we're trying to look at leading indicators here. Those leading indicators are super important. So let's have a look at the money and credit data, because we've looked at the mortgage approvals in terms of new purchases, but there's some interesting data out this week, end of last week, I think it was this week, about refinances as well. Now, this is mortgage approvals with the teal line being our overall, so not our new purchases. This sort of orange line here are the refinances that are going on. And you can see that these refinances have absolutely dropped off a cliff as well. Now, there's an article here that I found that said we've got, yes, in terms of purchase mortgages, lowest since Jan 23. Remember, that was following budget. But if we have a look at this little headline here, the net approvals for remortgaging fell to 20,600 in September, which is the lowest level since Jan 99. So that effectively is this sort of orange line here. So what that says to me is people are not remortgaging their homes. So it means two things. First of all, I think people are sitting on their hands and waiting because there is a clear expectation now that interest rates are going to be coming down on a consistent basis. I did a pre-recorded video this week where we looked at effectively this piece of analysis that was in mainstream media, okay, but it's analysis that we could be seeing mortgages fall by summer 24 to sub 4% again, which obviously is quite, still a lot higher than it has been for the last 15 years, but a lot lower than it is at the moment. And of course, I looked at this and went, right, we've got effectively some bright spark has put a straight line that goes from now to summer 24. And if it bisects, the 4% line by August, then we're going to be seeing sub 4% residential mortgages in August. Now, this was in mainstream media. So for me, it's really easy to imagine a case that people wake up, they look at the news, they see this graph and they go, look, interest rates are coming down. The perception is that interest rates are going to continue to come down at this sort of rate for mortgages. I'm not talking about Bank of England base rates at the moment, I'm talking about mortgages. Therefore, as my fixed rate, my nice cheap fixed rate debt of probably 2% or lower expires, rather than fix onto something else, I'm just going to sit it out, wait for 6 months as these interest rates come down and settle down. Now, history will say if this is a good plan or not. The honest answer is we won't know, probably for a good sort of 12 to 18 months. I'm not going to talk about inflation today. I'm not, and all of the factors that could lead to interest rates not doing that. Remember, mortgage interest rates are based on swap rates. Swap rates are very sort of reactant to market news. So let's say, for example, that CPI print comes out this month and it goes up, which I don't think it will, by the way, because remember, last year, there's a big drop off in the 12 months data that we're going to see this year, plus the energy price cap. So we should be seeing a fairly large drop in inflation in this month's print, in November's print. However, after this month, when you look at the rolling 12 month, we're going into a fairly stagnant period that's going to fall out the data set. So if inflation is feeling sticky, which I feel it is, we might well see secondary inflation hit beginning of next year. Now, if secondary inflation hits, there's probably every chance that mortgage rates could go up again in the short term. So this graph might not be completely sort of accurate, but people, I feel, and again, if we go back to this, people are not refinancing their properties because they probably think that interest rates are coming down. So they're sticking with it. Now, that means they're probably going to be sitting on higher interest rates for a long time. The second thing this means is because we're not seeing house price inflation, we're not seeing remortgages, refinances, if house prices are going up and people are refinancing their property, generally they are, well, not generally, very often what they'll do is they'll refinance with a higher amount of debt, pull some debt out, and that becomes equity that they've got to spend on stuff, okay? Extensions, house renovations, new cars, buying stuff, going on holiday, right? That's what people do. This is where a lot of people's passive wealth comes from, is from within their asset. Property is an asset. If it goes up passively, we can refinance, pull money out and buy stuff. You buy stuff, you stick money into the economy. It stimulates the economy to grow. If this is not happening, if we're not seeing house price inflation, and we're also not seeing anybody refinancing their properties, it means the amount of money that is out there is going to reduce significantly. Amount of money reduced significantly is going to feed into the economy. And this is where we get into this very fine balancing act of, and this is what, effectively the MPC tomorrow is going to be probably talking about quite a lot, is how far do they push it? Because what people don't want to do is be pushed into a severe recession, which would end up, costing homes, costing livelihoods, and causing a lot of issues for people over a period. And the question they're going to have tomorrow with interest rates is, do we want that to happen or not? And if we put up interest rates more, is this going to happen? So at the moment, there's not money going into the economy. Now, if we scroll down on this, I think here's an interesting graph about household M4. Now, just to explain what M4 is effectively money supply that households have. Okay, you can see at the bottom it's broken down into interest-bearing site basically means it's an interest account that's instant access. You can take it out. Interest-bearing time is a savings account that is locked up for a period of time, like a 1-year account. ISAs are self-explanatory. Non-interest-bearing site will just be like a current account with no interest rate on it. And notes and coin is your physical money. So household M4, right, is the physical amount of cash they have in the house and in savings accounts, investment accounts, things like that. Okay, so we can see very obviously here. And again, I think actually what I've done is put it. Did I put it on? No, I didn't put it on the iPad, so I can't draw in it. We've seen over the last few months, and really since the beginning of this year, a net withdrawal of M4. So M4 has been shrinking, which effectively means that people are starting to chew through their money. You can see in COVID, right, it's a very obvious trend of M4 increasing. People had a lot of excess money; they couldn't spend it. There were furlough payments, there were bounce back loans, there were CBILS. There was a lot of money sloshing around the system, and a lot of it, as you can see here in the blue, ended up in effectively instant access savings accounts, which is the blue and the sort of yellowy there. What we're now seeing is a switch from that. So a lot of money inflow, into accounts are going into longer term interest rate accounts, which makes sense because savings accounts are now paying a lot more. But we're seeing a big net outflow of your instant access savings accounts, and we've seen quite a few months of negative outflow, which effectively means household deposits are shrinking, which probably means that people are chewing through that liquidity to get through that cost of living crisis and to get through, to carry on paying their mortgages. If we look at this chart here, it's kind of difficult to see. This household M4 is the blue, so we can see we've had a few months this year of negative outflow. The last month is actually one of them. Bizarrely, I don't know why they do chart this. This orange is money inflow into national savings and investments, NSNI. And this month has seen a huge influx into NSNI. And I looked into why that might be. They've actually just increased the interest rate on NSNI. So your chances of winning, prizes on premium bonds, for example, have gone up, by a fair amount. So it looks like people have taken money out of instant access, stuck it into national savings and investings, but there's still a net outflow. If you zoom in on that, you can see it, a net outflow of M4, right? So people are burning through their money. I think that's interesting as we go into the end of 23 and 24, because I said for an awfully long time that I feel we're in this race. We're in this race between people running out of liquidity and interest rates coming back down again. Which is why tomorrow I think is going to be a really interesting decision. By the way, the massive consensus is they're going to stick at 5.25% tomorrow. Looking at the analysts, we have an 80% sort of prediction on sticking and a 20% prediction on going up to 5.5. I'm starting to increasingly see people talk about, have they already gone too far because a lot of those interest rates haven't fed into the system yet? And do they actually need to start bringing it down to stop us going into recession? We are seeing, more strain on the economy. And when we're seeing this sort of net reduction in borrowing and lending, it means, that's going to start filtering in more. And is it going to take us into recession in 2024? Okay. So those are a few things to mention. I think, by the way, as I was looking through this, there are some other things that you can see in terms of graphs on trading economics, which are vaguely interesting to have a look at the moment. One of the ones that I did want to have a look at was price to rent ratio. This is interesting as an investor because we can see the continued curve down of effectively, this is house prices versus the rental income. So as this line comes down, our yields are going to go higher. So as a property investor, we want to see this. If you're a yield investor rather than an equity investor, or you're looking to sort of create that legacy growth, if you want yield, cash flow on a monthly basis, that line coming down is a good thing. So the further that comes down, the more we're getting back into the zone of having nice cash flowing and yielding properties. Anyway, let's go back to the slide deck because I want to talk about what's actually going on. Let's do a synopsis of where we are. I feel we're in a frozen market at the moment. That frozen market and massive drop in transactions has completely skewed the data. So yes, we've seen a 0.9% rise. I think we need to take that with a massive pinch of salt. We're still in a confirmed downtrend on the Nationwide. One of the big things is because there is still that liquidity in the system because our unemployment is still relatively low and we are in a tight labour market, although it is softening. And because we have a lot more bank intervention is not the right word, but banks are not starting repossessions for a minimum of 12 months. If you remember that charter they entered with Jeremy Hunt, there's not a lot of forced sales going on at the moment. So even though house prices are coming down, we are not seeing forced sales, and forced sales would lead to a spike in supply. Spike in supply would cause it to get into that spiral of crashing. We're not seeing that. We are seeing a reduction in supply, which means people are sitting on their hands and waiting to see what happens. So are people waiting? I believe they are right now. We are seeing a net outflow of M4. So this is probably cost of living, other people's mortgages increasing. And don't forget, we are still, for another year and a bit, still seeing over 100,000 people every month come off the cheap fixed rate loans. So I believe this supply of M4 is going to become shrink even more as we go over the next 12 months. And this is this race, right? More people every month are coming off the cheap debt and having to absorb these higher interest rates. So that will continue as a trend into next year. So that's the interest rate drops versus liquidity. Real house prices here, though, are the main picture. So as an investor, I care more about the real house prices than effectively the nominal house prices, because real house prices are showing the value of a house inflation adjusted. So everybody talks about house prices still going up, the house price crash isn't happening. I talk about this every time we talk about house prices, right? House prices are crashing in terms of very real term value. So when you look at the price of a house or the cost of a house in relation to everything else, it is devaluing right now. And as nominal wage growth goes up and the real house prices are still coming down, that means the affordability is actually improving for people. So we are still seeing nominal house prices go up, nominal wages go up. So the thing that's actually really important to understand is what the price to earnings ratio is at the moment. I feel that this nominal house price discussion is a bit of a red herring as to where we are in terms of the property market, right? And what's actually going on in the property market. Because in a high inflationary environment with high nominal wage growth and a stagnant, if not dropping property market, we're actually seeing houses devalue a lot. I keep referring back to this piece of analysis by the Resolution Foundation. This is a graph up to 2021 of the house price to earnings ratio, where we're sitting sort of about 8 times. I suspect we're going to continue to see house price to earnings drop down to be that sort of just sub 6 times. And that's where it's going to be settling. Now, of course, with nominal wages going up, it means that could be higher than it is now in terms of, our nominal house prices. But it's that is the important metric for us to worry about. Okay, so that's what we want to carry on looking at. We want to carry on looking at the real house prices. But there we go. That's the overview. Oh, sorry, one more thing. I want to leave you on this before we talk about interest rates tomorrow, or we're not going to talk about it today, but we're going to get back tomorrow on another live after the bank has its meeting. I always go back to this. There is a cyclical and symbiotic relationship between the housing market and the economy. And right now we are at a tipping point with both, I feel. The thing I want to focus on is, where is confidence right now? Where is consumer confidence? If you look at consumer confidence graphs, they are low. They are very low. The fact that banks are not lending, the fact that people are not remortgaging is going to have that perception that people are worse off, especially if they look at the price of their properties and feel their properties are actually devaluing. They cannot take money out. They cannot spend money on stuff. Therefore, people consider they've got a fall in wealth, confidence drops. And this then sparks this cycle of lower spending. People have less to spend, lower spending, and a fall in GDP. Will that lead to recession into 2024? And if we do that, that will then contribute to that spiral of increasing nominal house price falls. And I think tomorrow, with the interest rate decision, is going to be super interesting to see where the interest rates go up. Because if they do put it up, right, that's probably going to accelerate that cycle. So we'll see what happens tomorrow. That's what I've got for you today, team, on Nationwide. I'd love to know your thoughts. I'm going to have a look at the comments now and go through. By the way, I completely forgot to say at the beginning of this video, I always ask everybody for a favor, and that is to help me grow the channel, because the point of this channel is not to be sensationalist, is not to be at one end of the spectrum. And I understand that on YouTube, on social media, the more controversial you are, the more one end of the spectrum you are, the more clicks you're going to get and all that sort of stuff. I don't sit there going, property prices are always going to go up. I don't sit there going, we're going to have a 35% fall. I try and look at this data and go, actually, what's going to happen? And my firm prediction is we're still going to be longer and shallower in terms of an annual property correction, and it's going to go on for a while. I suspect real house prices are going to continue to correct for another 5 years or so, is my prediction. I know that means I don't get all the clicks that other people get. So my request is to ask you to help me to grow the channel. And one of the things that YouTube loves is subscribers. So the only favor that I'll ever ask you for this channel, and the point of this channel is to help you or empower you to take ownership of your financial future, looking at objective data and looking at forward-looking trends. The only favor I'll ever ask you is to subscribe to the channel and like the video so we can get more reach, because the more reach we get, the bigger the channel is, the more resources I can put into it, and get you more data and more content out that I believe is helpful. So please, if you could subscribe to the channel if you're not already, I would be forever appreciative, and I'll continue to work every week and get out this content to you. So thanks for that. Right, let's have a look at the comments. AM, isn't it the case that, I probably need to put these on actually, add to broadcast. AM, isn't it the case that the remortgaging figures only include people moving to a new lender, i.e. not remortgaging with their own provider? It's a good question, AM. I'm not actually sure on that. I will find out for you. I don't actually have the answer of that one, but we'll find out. It could well be that it's people. It doesn't include people who are refixing. My gut feeling though is that people are just sitting on variable rates as they come off their fixed and not refinancing in at the moment because they want that flexibility to refinance if rates do fall next year. Richard, does the remortgage data cover the boat? Oh, there you go. I think Richard's kind of asked the same question about that. So I'll find it out and I'll put it out in the community comments. Richard's saying, check out the increase in credit card debt. Frightening. NSNI just offered a 6.15% interest rate. Yeah, so this is why we've seen this big spike, I think, into NSNI, because they've sort of really upped that. So a lot of people are, taking any free money they've got, sticking it in that and locking it up. Ian, I've got 200,000 just sitting in bank savings accounts and premium bonds. What would you do with this sort of money? I would like to buy a buy-to-let. It's a good idea. Or would you stick it somewhere else? Yeah, great question, Ian. I'm going to try and answer that in an objective way, as somebody who's clearly slightly biased, because I am a property investor myself and also help other property investors do stuff. So my honest answer to that is we are seeing some fantastic opportunities in the property market right now. I'm putting some stuff together at the moment to put out into the community. But a lot of people still say there's no deals out there, or why would you buy property if it's going to be crashing in value? The answer is, the method that we use to do property investing is kind of completely unrelated to overall property prices and the overall trend of property prices. So I look for two things in a property investment. Number one, the ability to add value, and number two, the ability to generate cash flow. Now, in a very simple conceptual explanation of this, if you can find something and buy it at a price and add value that adds equity, right? Let's say 20, 25, even 30% value. Actually, does it matter if property prices are going down a couple of percent, 5% a year, something like that? If you can add 20 to 30%, and you can, there's many ways, many mechanisms we use to add that sort of stuff. I'm not talking about refurbs. I'm talking about things like buying distressed commercial, value arbitrage, using commercial to residential, lease re-engineering. There's lots of strategies we can use to add that value to property in a way that's completely unrelated to the bricks and mortar. So that's something to leave you with. When we add the value, we can then pull money out and leave very small amount of our initial fund. So you've got 200,000 there. Let's say you buy something in cash for 200 grand, do some works for it. Within that budget, you add a significant amount of value, and then you pull out a big chunk of that 200 grand. Let's say you pull out 180 of that 200,000. So you only got 20,000 of your own capital sitting in there. Now, all we care about is generating a return on that initial capital. So I call it ROCE, return on capital employed. There's various definitions that people use to sort of quantify a property investment. For me, it's the return you're getting as a percentage on the capital that you leave in that property. A normal buy-to-let with current interest rates is not going to give you a huge return on that, which is why I've not been investing in, when I say a normal buy-to-let, I mean like a standard single-let, vanilla single-let, like a 2-up, 2-down, 3-bed property where you just put a single-let tenant in. Interest rates up at 5-6%, you're really eroding your profit margin. So we look at other models. We look at high density units. It could be sort of blocks of flats, could be sort of bedsits, could be houses of multiple occupation, could be sort of higher density commercial. Let's say you take a big commercial, slice it up. It could also be something like short-term let, so you're renting stuff out by the night or by the week rather than to a long-term tenant, and all of that's going to increase your cash flow. Now we need to increase that cash flow to mitigate the higher interest rates. So when people are talking about, look, it just doesn't work anymore, property, because you've got these higher interest rates, wrong. Because if you've got a much higher cash flow, then it doesn't, the erosion of your net cash flow is much lower with the higher interest rates. So when we combine those together, you're going to get a very high return on capital employed. My criteria, by the way, minimum is 30%. Generally, are targeting 40 to 50% return on my capital employed for any property deal. And as we see those property prices come down, there are several markets or several demographics. Generally, I would say older buy-to-let landlords or more sophisticated sort of landlords, property investors, institutions who are offloading because they want to just cash in their equity now and go into retirement. That's where the opportunity is. So there are some fantastic deals out there. I would never just put all my money into one place. I would always hedge it. So I would always look at a risk pyramid. By the way, I'm not a financial advisor, so please nobody take this as gospel financial advice. But I would also always recommend you have some liquidity to tap into if you need some reserves. I would always recommend you, well, at the moment, you have probably some tied up in some higher rate interest rates, like the NS&I, 6% on your cash. So I've always got some money sitting there. It was like a fund if I really need it, although that's not instant access. You need your instant access liquidity. You want some money, probably at very low risk, but 6% is really good interest rate now for very low risk. But then the rest of it, I'll be deploying in these in property investments and getting this very high return on capital employed, as well as adding equity into the portfolio as well. So I don't know if that answers the question for you. If you're looking for more information of how to do that, I haven't flashed this up yet today, so I'll do it now. I do actually have a white paper on what's working right now in the property market, where we are as a property market, and how to actually generate high return on capital employed from property investors in the current high interest rate environment. It's robstewartglobal.com/white-paper. Feel free, please, just to go ahead and download it. It's totally free, and it gives you a little insight into how to do that. That's also if you want the link, it's in the description, should be in the description of the video as well. So I hope that's of some use to you. Okay, we've got any other questions on that? Just to round that off, Ian, I'm sure there's loads of places you can stick your money. The only places that I would consider myself knowledgeable on are property and my own businesses. So the other place I stick my money is I reinvest it into my own businesses. I have several. I class myself as a portfolio entrepreneur. I have obviously property business in both sort of development, investment, and trading. I have a group of scaffold companies where I sort of reinvest funds into growing the softer asset base of scaffold, which is steel and timber, and as well as sort of marketing / training company as well. So I have that portfolio of companies. So I would generally reinvest in stuff that I have control with, which is my property portfolio or my business portfolio. Okay, team. Right. Any more before we sign off for the day? Because I'm going to be going live again tomorrow following the MPC meeting to sort of give a little bit of feedback of what's going to happen or what will have happened in that meeting. Last week I was feeling fairly bullish about interest rates going up. Is that bearish actually? I thought there's a fairly good chance of us going to 5.5% tomorrow, especially when you look at, and what I'll do actually, no, sorry, I won't, because I haven't got that slide deck. When you look at some of the indicators, because we've still got that sticky inflation, in fact, I will flick it up because I think this is a really important one. I saw an article yesterday, mainstream media article, talking about how the reduction in house price inflation, so house prices coming down, is good to bring inflation down, and bringing inflation down is obviously a good thing, but we don't want to go too far because it's going to destroy the housing market. And what they talked about is house prices coming down, meaning inflation comes down. I think that's a fairly simplistic viewpoint to put into mainstream media. The reason I think that is because when we look, this is a graph from the last CPI print of effectively the housing element of CPI. So if I can zoom out so you can see it, this is the contribution from owner-occupiers housing costs. We've got two ways of looking at inflation. You've got CPI, which has the housing cost stripped out, and we've got CPIH, which has got housing elements in it. Okay, so the housing elements is this. Now, in this housing element, we've got, as you can see up here, we've got in blue is our utilities, electricity, gas, other fuels. That's very much out of control. We've got water, we've got council tax, we've got some regular maintenance and repairs. The big thing are these two lines here. If I just put that in here, where we have the sort of green is cost of rent or inflation in rent, and the burgundy is the inflation in owner-occupier housing costs, which is effectively what it costs you to own a house if you own a house. So at the moment, these are still going up fairly considerably. And this is why when we look into, going into the next 12 months, we've still got, interest rates are going to be sitting high, even if mortgage rates, are coming down at the moment, swap rates coming down. We're seeing this owner-occupier housing cost element inflating, and it's actually accelerating in its inflation every month at the moment. And we can see it has been really, since back here, which is, what's that? Basically end of 2020, beginning of 2021, we've seen the owner-occupier housing costs inflating. The trend is it's continuing to go up when you look at all of the factors that we talk about quite regularly. So inflation coming down as a headline figure doesn't mean that, let me rephrase that. Housing prices coming down does not mean that owner-occupier housing costs are going to come down. Okay, they're actually two completely unrelated things. So the price of houses can come down, but our owner-occupier housing costs can go up because, of course, rents are going up, interest is going up, the cost of owning a house is going up. So the two are actually completely, independent of each other. So let's just see if I've got the other slide here. No, we don't actually. I haven't got all the slide deck. I just brought this up in case we could see it. There'll become a point very soon where this owner-occupier housing cost element is going to meet the main CPIH downward curve. So imagine this is going up. Let's just come here. This is going up. Main CPI is coming down. Kind of, let's go that way like that. So that's the right way around for you. And it's going to, effectively make this whole thing very sticky. So when people talk about the sticky inflation, we're seeing various elements of that CPI print that are not coming down. They're actually coming up. So a lot of the stuff that's making it come down are still the supply shock of the utilities coming out, the supply shock that went into the food chain coming out, but there's a lot of other stuff that's still feeding in. And of course, depending on what happens in the Middle East and Gaza, and if that sort of spreads into the area, that could have a massive effect back into the supply side if that starts spreading around the region and affecting oil prices, affecting imports, affecting grain, affecting food, all of these sort of things, right? So we are by no means out of this right now and are just seeing a clear trajectory down of inflation coming down, and house prices coming down are assisting that. Right, the two are not linked. I'm trying to remember why I got into this onto this subject, but I think the point is we need to see what's going to happen with the interest rates tomorrow, and then see what happens with the inflation later on this month, to see what the trends are doing. There we go. What we got? We've got some other comments. Let me just go through them before we end for the day. Richard saying, Ian, invest it in Rob's business. I would love to take it, but I generally don't take external funds into my businesses themselves. I think it can just create problems sometimes. Thank you, Gary, for your input. That's a good presentation. Connor saying 30% drop. Could what happen, Connor? As I always talk about, there is a range of probabilities with different possibilities, or no, other way around, range of possibilities with different probabilities. I don't think we're going to see a 30%, 35% nominal drop. I know there is, a popular channel that people keep saying I should do some sort of collab with, saying that. I right now, in terms of the current trends, I can't see a 35% nominal drop. I'm not saying it won't happen. I just can't see with the current trends. And the reason I'm saying that is because of the affordability, the price, house price to earnings ratio coming down, is going to soften that blow, and it is going to settle. And because we still see strong wage growth, it's going to settle the nominal house prices. I 100% think we could see 35% net drop in real house prices. Like, without a doubt, I think we're 15% already. So I think over the next, sort of 2 to 3 years, we could easily get peak to trough 35% in real house prices, maybe even more. And that is relevant, right? That's super relevant. I'm struggling to see the nominal, unless here are the reasons, okay, about why we would see 35% drop in nominal house prices. We go into a deep recession, we see that unemployment spike up, and we see repossession spike up. that will see a 35% drop in nominal without a doubt. But we are also running into election. We are seeing government intervening, not massively, but just things like banks delaying repossessions, which, by the way, all that's doing is going to push things down the line. But if it pushes things down the line, it gives people that breathing space whilst the interest rates come down. And that could happen. By the way, everything I'm saying is my viewpoint. It doesn't mean it is going to happen. I just think looking at the trends right now, this is the most likely course that we're going to see that shallower correction over a longer term time period. Okay, Vaughan, house prices are falling, no doubt about it, and will continue for some time yet. Sold my rental property for 250,000 more than I would get now. That's all, and I do believe, by the way, that house prices are falling as a general. It also depends where they are, what region, and who you're selling to, and who you're buying from. So we've been buying some fantastic deals, by the way, this year, and some of my clients have been buying some fantastic deals. Literally, I bought one early this year, mixed-use development with 4 flats and a retail space that had been marketed for 450. We bought it for 345. None of my clients similar, been marketed for 400, bought it for 335. We just secured one that was the vendor were looking for 1.1 million. We just got it for 908. So there are some fantastic deals, and that's kind of like a snapshot of nominal price. Getting price purchases. I don't care about the nominal really. It's all about, as I said, that return on capital employed and what we're going to be getting as a return. So without a doubt, there are huge opportunity there. Again, those of you who know me will know that I sold my personal house beginning of this year. I put it on the market last summer, fell through. When the mini budget happened, we got another buyer quickly, and I think I sold it pretty much at the peak of the market. My partner also did the same. So we both sold our properties basically end of last year, but they completed beginning of this year. We've taken the equity, sitting on some of it in long-term higher interest savings accounts, and the rest of it is deploying into the property purchases we're buying now to get a very high return on capital. And of course, we're in rental at the moment, which gives us a lot more, protection and flexibility. And the income coming from the things we're buying are paying for the rental. So that's how I look at reorganizing my things. Okay. Let's see what we got. Connor, basic maths is the reason people can't afford the current rates with higher inflation and food costs. Yep. No, I agree with what you're saying, Connor. I just don't think 35% nominal is where the basic maths point to at the moment. Is my gut feeling. I think a 35% nominal price drop is massive, and I don't just think the cost of living crisis and the interest rates will necessarily lead to a 35% drop in nominal house prices. I think it will lead to a big reduction in price to earnings ratio. And that, if I just to get into a good debate about this, because I know Charlie talks about the maths, right, and likes to look at it. And I don't disagree with the concept. I just maybe have a slight disagreement with the rates. So this to me is what is the big thing that drives house prices. So there was a good piece of research about the effect of real interest rates, and it's important to note real interest rates and the persistence of real interest rates, and that what that will do to real house prices. But remember, real house prices and nominal house prices are two very different things. So the piece of research, which is in a Bank of England working staff paper, suggests that a 1% increase in real house prices that is persistent will lead potentially to a 20% reduction in real house prices over, and it says, a significant amount of time. So it doesn't quantify what a significant amount of time is. It doesn't quantify how persistent the interest rates have to be. But this is why my belief is that we'll see, I think 35 to 40% could be easily on the cards for real house prices. But the thing we need to understand for nominal house prices is that price to earnings ratio. And because we're seeing strong wage growth, at the moment, I admit, we may have peaked on that wage growth. As wage growth nominal goes up, okay, our house prices will come down, but it's going to be softened. Because if we settle, and again, this piece of research is modeling, let me just take oh, no, sorry, I don't want to take the green off that. If we take the green off this, no, it's going to do, sorry. I'll just go here. If we take the green lines off this, which I can't do, we just look at this little red dot here. This is a 5.8 times price to earnings ratio. And we're anticipating, or this reckons, if interest rates are modeled, this is nominal interest rates, not real interest rates, at about the 3.5% base rate, then price to earnings ratio would settle about 5.8 times. And when you follow those maths, that math through, that's not going to lead to a 35% drop in nominal house prices, unless wage growth starts going into reverse, right? And that is possible. That is why if we tip into recession and people start losing their jobs, that is when I 100% agree, we would see 35%. The question is, will we go into recession and deep recession? So that is the unknown. And anybody that says we will do, okay, I feel is speaking from either a sensationalist point of view to get views, or maybe has just internalized that will happen. I don't think anybody with certainty can say we will go into a deep recession. And all we have to look at right now is where we are. And there were a lot of forecasts this year that we're going to go into deep recession. We haven't. I'm not going to get into GDP data right now because we look at GDP when it comes out every month. So I don't want to get into that right now. Of course, I believe the figures are skewed to make the narrative, but it's difficult to unskew the figures and say we're just in deep recession right now. Possible that 2024 we will go into recession. And again, this is why the interest rates are so important, because I think if we carry on going up with the interest rates, I think we will go into recession. So tomorrow is going to be interesting. There's a lot of leading indicators that are showing resilience in the economy. It is not like we are just about to melt down into a horrible recession and see unemployment above 10%. Again, let's not talk about the accuracy of unemployment figures and what we're actually comparing with them, because that is a whole different kettle of fish. What I'm saying is at the moment, I think we could go into mild recession, but the labour market is still so tight in a lot of areas. You know, what will happen to the unemployment and how much liquidity is there still in the system? And do people have enough to get through this period? That's the big question. Nobody can answer it. There we go. So let's see what we've got. Richard, real house prices, inflation adjusted, are only relevant for affordability. Your wages are going up accordingly. A good number of firms can't afford that, and in reality, just hanging on. Yeah, I don't disagree with that. I think for most homeowners, by the way, real house prices are completely irrelevant. They don't care. They only care about nominal. As an investor, I care about real. And the reason I care about real as an investor is because it's obviously the actual value of your investment. You know, if you can be putting stuff in that's going up in value more than property, then it might be better to put your money in something else. Also, as an investor, I actually only care about cash flow. I'm a cash flow investor. So the actual equity within the property, as long as I can service the debt and there's no covenant in there saying a bank can come and swipe my asset away, is relatively unimportant in the short to medium term to me. It's all about the cash flow. AM, here on the front line running a company, it feels like we're in a mild recession, even if technically we're not or not yet. AM, I'll be interested to know what sector you're in. I'm in scaffolding, and I can tell you right now that we have never been busier. The issue we have, and I probably have slightly skewed view of it, because I do understand there's going to be differences in different markets, and this is why I'd never say this is what's happening. I would say in construction, because I think the labour market is much tighter in construction, for the main reason I think Brexit has contributed to a lot of skilled labour leaving the country. And I also think there's demographical changes with younger people coming through the system and not wanting to go into skilled trades. Therefore, there's much less people doing apprenticeships. COVID has, without a doubt, seen a lot of the older workforce leave the workplace and decided not to come back. They've gone, right, now's the time for me to sort of pack up and stop working. And that is not being replaced by younger apprenticeship style workforce coming in. And therefore, the labour market in construction remains massively tight. So our issue in the scaffold business is nothing to do with work. The work, we've never been busier. It's to do with we cannot scale because the workforce is not there to scale into it. What that does mean, by the way, is the work that we are doing, that past the parcel inflation, our prices have gone up a lot over the last 12 months. But yeah, we have scale issues because we just cannot find workforce. And that means there's always going to be a supply-demand imbalance. And I think that's the case with a lot of trades, brickies, sparkies, plasterers. So construction, the inflation in construction industry, I would suggest is high. I get other industries, perhaps, for example, IT, right? There's probably a lot more people come out of university wanting to get into the IT. So there might be a lot more labor, people looking for jobs in that sort of space. And maybe there's not the jobs there. So this is going to be very sector dependent. Totally understand with that. It's very difficult to see a big picture of everybody because I think there's so many little micro economies going on, if that makes sense, AM. So yeah, I would be, oh, there you go. Translation. Okay. I don't have an awful lot of knowledge about labour force in that. So I'd imagine I can't contribute an awful lot to the discussion about what's going on in that sector. All we can talk about is our own sectors, isn't it, at the end of the day? Neil, how are you doing, Neil? A lot of houses in London in our area priced over 1 million are sitting on the market on Rightmove, so sellers don't want to take lower prices. So we'll need to see a lot lower volume. We will see a lot lower volume in the market. Yeah, and I think this is what I mean about the market being in total paralysis at the moment. People are not being forced to sell. And that means supply is not coming on, which means it's propping the whole thing up. If we see that supply-demand imbalance change, which a recession, people losing their jobs, will do, when we start to see forced sales, that will change the market if we get to that point. That's the question mark. Do we get to that point? Do we tip? Does it tip? And do we go into crash territory versus correction territory? Because right now, it's just frozen. I agree, by the way, in our areas, we're seeing a lot of £1 million properties just sitting there. And generally, people who own property like that, unless they have leveraged themselves up to the hilt during COVID with cheap debt and now they can't afford their mortgage, a lot of people with a lot lower amounts of debt on those sort of properties, maybe they've owned them for a long time, debt's paid off, they've got a lot of equity, they do not need to sell. So why would you accept a massive hit when you could probably just wait it out a couple of years? I saw a YouTube video, some friends of mine who do developing, that's saying they are struggling to sell some of the, they're coming to the end of some developments, struggling to sell some of the property, but why would they sell it? They don't need to sell them. They're not prepared to drop the price because they just don't need to. And instead, because the rental market is so buoyant, they are holding them and renting them out instead, either short-term let or service accommodation model, and actually generating a lovely cash flow from them to give the market a couple of years and interest rates start correcting and then look to sell again when the demand is up. Emmanuel says, I don't think we'll go into a deep recession, a mild recession most likely. I agree. I think mild recession, and don't forget recession is a technical term. We're not far away, from technical recession. For me, when I say deep recession, it's that huge spike in unemployment, right? That's the big thing that would trigger this. Remember, I say there's three things that cause a crash. Number one, affordability. Number two, negative equity. Number three, unemployment. We're not really seeing that unemployment at the moment. And there's still liquidity in the system, even though it is net outflowing right now. Interesting. AM says using freelancers, AI is having an impact too. This, by the way, is a totally different subject. It's artificial intelligence, which I would love, and I've committed before. And this is what I mean about growing the channel, getting more resources. I want to spend a lot of time into looking at impact of AI, because I think this is the most fascinating, topic for all of us, almost existentially as a species right now, is the impact on AI and what it's going to have on everything, what it's going to have on the economy, what it's going to have on jobs market, what it's going to have on property prices. This is an extremely interesting period of our growth as a species. Let's not get into it now, but interesting, AM, that you're saying that AI is having a big impact, and I can see how that would have a big impact on the translation market for sure. Luckily, I can't get AI to replace my scaffolders just yet, because they don't have the ability. AI right now doesn't have the ability to erect scaffold, but I'd imagine it'll only be a matter of time before there is AI robots who can do that. So that's an interesting thing to look at, but we're going down a massive rabbit hole now. Neil, inflation runs at 5%, then over 5 years, if house prices don't go up, it effectively a decline of 30%. Yes, exactly. Yeah, I totally agree, Neil. 100%. Which is why I think that sort of talk about 30 to 40% decline in real house prices is absolutely on the cards, almost as a very high probability. But a short. By the way, I'm not. When I say I don't think nominal house price will go down 35%, I don't think they're just going to flatline. I would predict if I was forced to a 15 to 20% reduction. I think 35% just feels high for where we are at the moment. As we talked about with Richard, subject to the economy. Right, team, I'm going to wrap it up there because we've been on for an hour. I hope that was useful. As always, please give me a like, give me a thumbs up. If you want to catch all of these live streams, we'll go live tomorrow. Please make sure you do hit that subscribe button. I would be eternally grateful, and we'll continue to dedicate a lot of my resources to this. It's more interesting than scaffolding anyway. So I will see you tomorrow, probably tomorrow afternoon. We'll talk about the MPC meeting and where we go if it's 5.25 or 5.5. I suspect it won't be 5, or definitely not a sub 5. Been a pleasure, team. See you tomorrow.